Okay. So, hi everyone. Welcome and thanks for joining us. The session will be recorded and will be shared afterwards. We're excited to hear from our speakers, Nick Agharkar of Crown Point Tax and Wealth Counsel, and Lance Rothenberg of Rothenberg Tax Law LLC. Feel free to drop questions in the chat. And with that, I'll hand it over to Nick and Lance to kick us off. Thank you.
Hey, thanks, Doreen.
Thank you.
Hi, everyone. So a little bit of introduction. We can go to that introduction slide, Lance. We want to, yeah. So my name is Nick Agharkar. I am the owner and managing partner of Crown Point Tax and Wealth Counsel. I help small businesses, physicians, and other folks who need help saving money on taxes and building wealth, achieve that goal by asset protection and also understanding the tax code. That's me, Lance.
Hi, everyone. Good morning. Thanks for having us. I'm Lance Rothenberg. I'm a tax attorney located in Morristown, New Jersey, and I specialize in two areas: in tax controversy, so helping companies defend against audit, companies and individuals, whether it's the IRS or a state, usually New York, New Jersey. And then I specialize in state and local tax, helping individuals and companies, not from an accounting standpoint, but from an attorney standpoint, figure out how to move across a jurisdictional boundary and all the fun that brings with it. So that's it for me.
So today we're gonna talk really about five topics. But first and foremost, Lance and I are both attorneys, and what I tell folks during these kinds of talks is that while we are attorneys, we're not your attorneys. So none of what we're going to say is legal advice. Again, remember, all of this is for educational purposes. We're hoping that if you folks do need some specific guidance, that you please do reach out. Our contact information will be at the end of this presentation. Lance, anything you wanted to say here?
Yeah, just you can't trust anything Nick and I say. This slide tells you that you have to hire us or someone like us. So this is just for fun.
Awesome. So we're going to start by taking you through, five different topics. There's been a lot of changes in the tax code with the One Big Beautiful Bill Act, and we're going to start with something that I think everybody wants to hear more about, which are the 168K, the accelerated deductions. That really, this is bonus depreciation. So if you'll all remember, in the TCJA, that came out in 2017, bonus depreciation was staged. So there was 100%, then 60%, then 40%. That's done away with. Now it is all 100% depreciable. So I think, Lance, we can go to that next slide. And so in order to qualify, and again, this can really, as the slide says, not only accelerate deductions, but boost cash flow, right? Especially in years where, things might be a little bit tight and we just aren't going to have that view in terms of the tax bill that we're going to need to pay. We can certainly reduce that by taking the bonus depreciation. But first, we have to make sure that we're buying qualified property. Now, one of the interesting pieces that the One Big Beautiful Bill Act did introduce is the qualified production property now. So there are some cases of building non-residential buildings, so long as I believe the construction has to be done by the end of the decade and the building placed in service by 2031. But you can actually deduct buildings as well if your business is real estate development. But again, this takes planning. And the other thing is that what we're really going to focus on today is the placed in service. What does it mean to be placed in service and actually being used? Certainly, we have to make sure that if we're going to be able to take this bonus depreciation of 100% depreciation on property, that we place it in service before the year end. So that means that it does have to be ready to be used in your business. And what's awesome now is that 100% bonus depreciation is permanent. So in years that you are looking at your books, and we all should be doing a lot of P&L analysis every quarter, it's certainly what I do with my clients. We should really be looking through what are those property, what's that property, what's that equipment that we can purchase in order to take an advantage of this stuff. And again, making sure that it's ready to go before the year end. And as always, we have to document. And so I think that's part of what Lance is going to talk about next. But you have to maintain your records, right? Take photos of the property being used, right, in your business. Make sure that you have invoices, that you have everything sort of squared away in terms of your documentation, so that we can prove up that this is qualified property, that it was used in your business for a productive income producing use, and you have all of the documentation to show that yes, we should be taking 100% of this bonus depreciation. Lance, I think we have a case next, right? I believe so.
Do yes. So okay. So one of the things that when Nick and I were, designing this, I'll call it this course, but this webinar is, as a financial planner, wealth advisor, he would sort of talk about some of these strategies, things that are completely lawful and allowed for in the Internal Revenue Code. And then as a defense attorney, I would talk about some of the ways these things break down. So that way you sort of see the good and the bad of these transactions. And so we've got baked throughout some more colorful fact patterns. They're all real. These are live cases. They're not my clients, but they're published decisions, the ones that we're going to talk about. And they sort of highlight sort of the extremes of how these things can go awry. But therein lies the the value, I think, to see that if you don't do this right, and right is it's not always easy to figure out how to do it right. But if you don't do it correctly, then you can have major problems. Major problems could be just loss of the benefit of the strategy that you were hoping to employ, or significantly worse, as we kind of we'll talk through some of that. But in this instance, I found a case. I love this case. It's just a fun one from 2013. So it's a little dated now, but the concepts are highly relevant. So this is about an individual, Mr. Brown, Michael Brown, who was a very high net worth life insurance salesman to ultra high net worth individuals. So when he went to sell a policy, the premiums on those policies were worth a significant amount to him, in terms of his compensation. So he would need to, and wealthy people have the ability to sort of travel around and themselves and have high expectations for their advisors. So he felt he needed to get there fast to meet with people. So he was relying on commercial airline, just like regular Delta or United Airlines, and that wasn't working. So then he was chartering flights. And but charter flights aren't always completely reliable either. Sometimes, there'd be a higher need and the charter plane wouldn't work. So in one instance, he lost an $8 million commission on a deal because the charter plane didn't work. So that sets up the facts where he decided in this case, he needed to buy his own plane, right? So, and he's wealthy enough to do that. So he goes to buy a plane, and this is in like November, December when he's deciding this, and the Congress at the time, the 168K sort of went from you could depreciate 30% and 50%. Nick just told us under recent legislation now you can deduct 100%. So again, these things are changing a lot depending on congressional priorities. So that alone is one thing you have to understand. But it had just gone to 50% bonus depreciation. So he wanted to rush to get this plane purchased and in service during tax year 23 because he had a lot of income. He wanted to deduct it and utilize this strategy. So he bought the plane, and he wanted certain design modifications to suit his needs. So he wanted to take out some of like the lounge seating and put in a conference table because he wanted to be able to meet with clients or just his team and sit and be able to work on the plane. So it was like a flying office. And with that, he also, in this conference room that he was designing, he had 17-inch screens, pulled them out, and he wanted 20-inch screens, I guess, so he could have, a bigger PowerPoint presentation or whatever. But these were, he testified that these were important very important for his use case. Well, that turned out to be problematic because the manufacturer could get him the plane, but they couldn't get him the plane with these modifications in time by December 31st of that year. So he took the plane and then he traveled around like 4,000 miles. He flew it from Portland to Chicago, had a lunch meeting, then flew back. And then so that way he felt he was using the plane for business during calendar year 2003. And then in early 2004, they made these modifications, and this office was completed. But he claimed these deductions, and then they ultimately they were challenged, and the dispute came down to whether the plane was in service, like Nick had said, and whether it was ready for the particular use to be in service in '03. And remember, he had made representations that these modifications were really important for his needs for this flying office. And the IRS, and then the court ultimately agreed with the IRS, had made the argument that, look, if you need these things for the plane to really work for your use case, so such that you could get this, enormous $11 million deduction, because it was a $20 million plane, so he was deducting, 50% of it. They said, look, these things weren't completed until 2004. So if you really had to have the conference table and all that, then this flights that you were taking on December 30th, the day before the end of the year, whatever they were, they don't count. So that's sort of illustrates that you've really got to understand the rules and then how they apply to you and then how they specifically apply to you. But there's one more sort of point that I want to bring out from this case, and then we can move on, is in order to demonstrate that these flights that he had made before the end of the year, when he was flying from Portland to Chicago, later when the audit was happening, because remember, an audit always happens 2 or 3 years later from the year in question, he created thank you notes for the file, right? To say, hey, that the meeting I had was legitimate because here's some thank you notes. And the auditors felt that that was very disingenuous, the way that he brought these up and did it. And they even tried to hit him with a fraud penalty, which is a 75% penalty. So not only were they saying that you don't get the deduction, they're saying that you basically committed fraud and that you should pay almost 2 times. So the court looked at this and said, well, we don't know that he committed fraud, but we do agree that he should pay some penalty because there's multiple levels of penalty. So they hit him with an accuracy level penalties. Suffice to say here that he had to repay the tax and then have a 20% penalty on top of that. So there's a lot at stake. This case, not every one of us in this audience is going to be buying a $20 million plane. If you are, great, talk to Nick. He'd love to have you as a consult. But for the rest of us, it just demonstrates that these things are serious. The IRS, New York, New Jersey, whatever dispute you have, they don't just look at the ultra high net worth. They're looking at regular people for these kinds of issues and these kinds of compliance. So you have to, you've got to take it seriously and understand what you're doing, have records to prove it, contemporaneous records to prove it, and you have to have qualified advisors walking you through it the whole way.
Yeah, Lance, from a planning perspective, the other thing is that when you take depreciation, remember you're reducing your basis in the asset. So when you sell it, there is going to be recapture. Depreciation isn't free, right? There is going to be a recapture of that depreciation. And so unless you're going to scrap the asset at the end of its life, really depreciation can kind of come back and kick you in the butt. Because while it's great up front, it can really be not great long term. And then, we pair that with the fact that there have been changes in the expensing rules as well. So Section 179 has been expanded to allow for immediate expense of up to $4.5 million in expenses for the business, right? So there are ways to sort of plan around these things, but ultimately we want to be thinking about what is the end goal here? What are we trying to solve for? Because I think perhaps even with this plane situation, there might have been better options than immediately depreciating a $20 million plane.
It's a great point. Great
Yeah.
point. Okay, let's go to the next strategy, the QBI.
Yeah, QBI is interesting because it came out of the TCJA in 2017 when corporate tax rates were reduced. And, look, S corporations, partnerships, multi-member LLCs, they said, well, wait a minute now. We are the backbone of the American economy. We're small businesses. how come we don't get a break in our tax rates, right? And so QBI was invented essentially for this purpose. And basically you get a 20% tax break, and you can see there on the in the spreadsheet, right, that it can be quite lucrative to take a QBI deduction, because if you have qualifying business income, you get 20% off. Now, there are thresholds and phase-ins. And so on the next slide, we're going to talk a little bit about sort of the planning issues that come with it in order to really think through QBI, because so many of us are going to be kind of outside that threshold. So the phase out for married filing jointly now is almost $500,000. Now, some of us may be, kind of falling within that, and so they can just take the QBI straight up. But if you're outside of it, not to get too far into the weeds, but effectively the calculation is based on W-2 payroll and also UBIA, which is the unadjusted basis and immediately after acquisition of the property, so your partnership interest. Now, remember, QBI does not apply to single member LLCs. So this has to be a multi-member LLC, an S corporation, or some sort of partnership. And this is why it's important then to be taking consideration of your property, right? And you're making sure that you have the proper calculations in your property basis, because that goes into the calculation as to whether or not and how much QBI you're going to get. Now, obviously, it's always a good idea to avoid commingling income. We cannot be treating our partnership or our S corporation or multi-member LLC as our own piggy bank. We have to make sure that we keep great records, that everything is separated, so that, again, we are calculating what your QBI should be in a very clear and concise manner, so that if any auditor comes along, we know what to do. And obviously, and I think, Lance, this was kind of what the case we're about to talk about touches on, is keeping complete payroll filings. Again, part of QBI touches on W-2 wage earners and what they paid and what you paid yourself and your partners as a W-2. And so it's important to really track and keep and maintain these records. And I think that's what Lance is about to talk about now with the Gill case. Is it the Gill case? Or no,
No,
Savage. That's Savage.
Savage. Yeah, thanks, Nick. Yeah, so as Nick was saying, this is a very useful and powerful and strategic tool that the code allows, that you're completely able to take advantage of this. And if it applies to you, you should. You can get some significant savings, and planning is important here. And this case is hot off the press. This is a United States Tax Court case. The Savage case just came out September of this year, so last month. And it just illustrates sort of how these things, the quirkiness with which tax disputes can come up. So in Savage, again, I'm just going to kind of very high level summary of the case to illustrate our point. But this was in the cannabis industry, which again is another burgeoning industry, brand new in across the various states, and a lot of interesting tax issues with cannabis at the state level, and whatnot. But one of the things that you have to remember in the cannabis industry, which again is now a sort of a big high dollar industry, is it's got a patchwork of legislation. It is still an illegal substance federally, but obviously it is now legal under certain conditions at the state level, including in New Jersey. So you can buy it and sell it under certain conditions lawfully, but it is illegal at other levels. So what that sort of means is odd results, right? And this is where, again, if this, this is a regulated industry, so they should really be thinking through these things perhaps very critically. But for everybody listening, is whatever your tax planning is, again, you have to kind of think not narrow, but both broad and deep, right? Am I doing the right thing under the right rules, the right way they're applied to me, to my industry, to my facts, to my business? And the burden is, it's important to remember the burden is on the taxpayer. I mean, again, the burden is a legal matter and it can be wherever it can be, but very often it will be on the taxpayer, and will almost always in an audit feel like it's on the taxpayer. So the best defense, the best offense is a good defense, right? Do the planning in advance and think through these issues as much as you can in advance. So in this case, in Savage, they claimed, again, they're in the cannabis industry, and they had $6 of payroll and wages paid in order to support the business. They had employees, but because cannabis and marijuana is illegal federally, like I said, there's some very weird things that happen to that industry. And there's something called 280E at the federal level, and it disallows deductions federally. Again, states, it's lawful and so forth, but federally, it's some sort of disconnect. Hopefully, Congress will decide, whether they're really going to allow or not allow this, or some work through. But right now, this is sort of where we are. So certain things are disallowed federally at the, from a tax perspective, and including certain deductions, including deductions for wages paid. Well, in calculating the QBI deduction to get the savings, they did pay these wages, and you get to include that in your QBI planning. So they said, well, we paid them, notwithstanding they're not allowed over here, we're going to claim them over here, right? And that was the dispute. If it's not allowed for this purpose, is it allowed for this purpose, right? And that's a real dispute, because in this case, which again just came out last month, you had the majority opinion that said one thing, and then you actually had a dissent where one judge disagreed and said no, the other side is correct. So these are thoughtful disputes that you can have. It wasn't just black and white, which makes it fun for people like Nick and I, very frustrating for taxpayers and business owners. But again, it gets to sort of why you have to really kind of spend the time and think through these issues. But so they claimed the wages paid and they lost, right? So they lost the benefit of the deduction, or at least it was greatly reduced. But again, the takeaway is, even there's a dissenting judge that said, look, that just because Congress disallows these things for this purpose, this QBI is a whole separate policy, and maybe it doesn't translate. If it's disallowed here, they should disallow over here. But the majority opinion said no, it's clearly disallowed. The way it's interpreted, it has to be a deductible expense. It can't be deductible because of this. So it's kind of a hip bone connects to the leg bone, right? So it's sometimes it's in the eye of the beholder, but it just gets to why you have to do your due diligence and sort of plan accordingly. And sometimes if you want to take positions, you should, but you should also sleep with one eye open, and maybe not spend all the money. Keep it sort of on reserve in case you have to give it back.
And the other
Nick?
thing to remember here is that there's no real state level allowance for QBI. So QBI is a federal law only. New Jersey actually decoupled itself from the federal standing in October of this year. So literally just this month. Effectively, there is no QBI on your state income tax. So that requires planning as well, because especially for those of us here in New Jersey, it is quite a bit of a high state income tax regime. And we'll talk a little bit about how we can get around that a bit later on in the presentation. But ultimately, we want to be keeping an eye on both of these things, right? Not only at the federal level, but the state level as well. And one thing I did forget to mention is, unfortunately, QBI still does not apply to service-based businesses generally, right? So Lance and I, out of luck for claiming QBI. Same with accountants and consultants and folks doing service-based businesses. But for folks like in the cannabis industry, this can be powerful if done correctly. So I think we can go on to one of my favorites, which are opportunity zones. So the TCJA created a really interesting way for business owners who perhaps were selling a part of their business, or folks that were going to realize quite a large capital gain, to actually reinvest and effectively defer that gain. And so there were a lot of questions about whether or not this was going to be touched by the One Big Beautiful Bill Act, and it was. And it was quite interesting what they did. First of all, they made it permanent. So the qualified opportunity zone.
Can you back up from it? You want to give like just a sentence or two, a high level on what OZs are as a policy perspective, sort of like what?
Yeah, absolutely. And so effectively, what the government has done is they look at areas that are quote unquote blighted, right? They're places where, reinvestment and redevelopment has not occurred in a long time. In our area, there are many in Newark, in Patterson, in Trenton, places where, you can see it. You can see some of the decay in the property and what's going on. And so in a way, look, I always always say this, the tax code is an incentive system. It's basically a way to get people to do things with their money in a way that makes society better. This is certainly one of them. So when a qualified opportunity zone, when the Planning Commission defines a qualified opportunity zone, now it opens up this ability for folks who do have capital coming in to reinvest that capital, effectively, quote unquote, lock it up for a number of years, and then defer the gain. And in fact, there you see on the slide, it's now permanent that if you reinvest your money, if you reinvest this sort of capital gain into a qualified opportunity zone for 10 years, that gain is 100% tax free. So this can be quite lucrative if you choose the right opportunity zone. So Lance, to your point, right? If you're going into an area that really there's no hope of it turning around, it is a bit of a risk with your money there because then it just may not be that much of a gain. But if you already are working in sort of, especially for those folks who are working in the real estate business and understanding where the investment dollars are going, who's building what where, this can be a really powerful way to really reduce your tax bill when, for example, you sell a business. And so, the clients I work with that really take advantage of this are business owners that are now either exiting or selling a portion of their business, and they're going to realize quite a large gain. I was working with a partner in a hedge fund who was going to realize $100 million gain, and we were able to take pieces of that, put them into qualified opportunity zones, and now lock them up. And so what the One Big Beautiful Bill Act did in its changes was it did create a regime where now not only is this permanent, but now we start on a 10-year rolling cycle, right? So the next 10-year cycle starts January of 2027. And so from here, we can basically say, look, we can do some really great planning in the next couple of years of figuring out what opportunity zones are correct, when the sale of the actual capital, the capital gain is going to occur, and really plan it out so that, hey, you know what? If I don't need this money really for 10 years, there's a way that I can grow it to a great extent and not have to pay any taxes on it. And that can be really, really powerful. And the mechanics are really on the next slide. There are a lot of what I just said, right? It's effectively you sell the asset, right? So you have a generated capital gains. You invest that gain into the qualified opportunity fund within 180 days. So some of you who are in the real estate world can sort of liken this to a 1031 exchange almost, right? Now it's not exact, but that sort of mindset can help you understand here how we're able to do this. So we need to make sure that we're really identifying that opportunity fund or opportunity zone really before we're selling that asset. That's when we want to do it, because ultimately these things do take time. And while you do have 6 months, you certainly don't want the clock to run out. And that's the reason why you get tagged with a capital gain bill. Again, you've got to hold the asset. You've got to hold that money in that qualified opportunity fund or opportunity zone for 10 years. And after that, the gain is excluded. And again, this is now permanent. So you're really able to take advantage of a really great way to come out with almost no tax on your capital sale, because you reinvested in a community that needed it, right? So that's ultimately how these work. But Lance, what do we need to know about these things in terms of not getting in trouble, right? We certainly don't want to go to jail for this.
Thanks, Nick. So as Nick just said, this was a program that came out in the TCJA Act in 2017, and it's a really good program for everybody if done correctly. It is intended to help taxpayers, and like Nick just told us, to shovel money back into distressed communities, to help those communities economically grow. Ultimately, the hope is to make them prosper. That's good for all of us. And the incentive is, if you do it correctly, then you can get certain significant tax savings. But therein lies sort of the rub, right? This is wherever there's a lot of money and a lot of rules, there's a lot of room for error, and that error can span the gamut from minor foot faults, which we'll talk about in a second, to some significant problems and even criminal activity, which we'll get to. So again, you've got a lot of technical requirements that some of, obviously we can't get into a really deep discussion here, but Nick kind of gave you a preview of some of these issues. So with that, there's always just a lot of little detail that you have to make sure you are doing the right thing that make sure that this is actually eligible for you and that you have the documentation to establish that and so forth. But so thought we would illustrate this in two ways. One is in order to claim this as just a threshold matter, you have to self-certify that you are eligible for this, right? So you have to, when you file the return, step one, you have to attach a form to it. Step two, the self-certification form. And it turns out that while most people are probably doing that, a lot of taxpayers are just failing at step one, right? They're not properly self-certifying that they have invested in this and that they qualify and so forth. And that can also, sort of, there's a range of reasons why that they just missed it, or they didn't file the tax return, or they filed the return without it and they didn't realize there was a requirement to do it. They were advised something, they misunderstood the advice. Their accountant did it, their lawyer did it. But at the end of the day, it's the taxpayer's responsibility. So the IRS, because this is a policy that, again, is intended to really help communities when they want it to succeed, has come up with a solution. They're trying to make it so that taxpayers, eligible taxpayers, can qualify. So there's a procedure where if you there's very detailed regulations on this, but there's a procedure where if you don't properly self-certify, then you can sort of write in and explain why this error occurred, and explain that, hey, this error was in good faith, and that you want to kind of get back into the program. And the IRS, they will evaluate that, and then if they agree with you, they'll sort of allow the late filing and the late self-certification to work. So there's a number of these letter rulings, private letter rulings, where again, I'm not going to sort of delve too deeply into it here, but a number of them where this exact scenario and this issue happened and taxpayers are allowed. So just missing the initial threshold requirement to claim these dollar benefits is you have to attach this form to your tax return, and people are just not doing that. So on that end, like I said, some of these people were writing in saying, well, my attorney was advising me and he didn't bring that up, and the attorney had just assumed that the accountant was going to bring that up. And they explained that, and they got an affidavit from the lawyer, or they got an affidavit from the accountant. So they kind of documented that why this was somewhat reasonable. And the IRS, again, because this is a program that they want it to succeed, where everything else seems correct, they're sort of letting people back in. Because again, if they had said, no, you missed it, you're just going to lose all the benefits. Go back to the earlier case with the jet airliner or the airplane, right? Like he didn't meet it by a month, so he was out. So here, if you just missed that initial filing, if they were strict, you could lose all the benefits. So again, on the one hand, the IRS is trying to work with you, even though you still have to. That is a process in and of itself. Filling out the letter ruling request, seeking that process the right way, attaching the proper, you can't just say I missed it, you have to sort of explain these people that where the letter ruling came back, allowing them in. Again, they had affidavits from the relevant parties sort of explaining what happened, why it was reasonable, why they should be entitled to relief. So again, everything is, in order to get these benefits, in order to sort of correct these benefits, there's a degree of diligence that you have to undertake, and that's important. But if you do that, in these instances, the IRS will sort of let you back in. So that's sort of an error on the front end. How about, let's look at something worse. Well, when I was looking into sort of breakdowns here, I found a really interesting one where in 2021, you had a Manhattan real estate fund manager who was charged with securities fraud offenses by the United States Attorney's Office for fraud with respect to opportunity zones. So in 21, he was indicted. In 2022, he was sentenced. He was sentenced to 48 months in prison. And so let's talk about poor Mr. Who's the taxpayer? Doesn't really matter his name, but since it's public,
Mr. Cheater.
Yeah, Mr. Cheater. So Josh Burrell is the guy's name, and again, these you can pull this right off the internet. not my client, not Nick's client, but he created Activated Capital LLC, which is some entity that he then went around to investors and to banks and said, "Look, I'm creating we don't know. I don't know that he wasn't in good faith in the beginning. He was maybe really was setting up opportunity zone funds, and then he was soliciting investors to try and get people to invest in these funds in this entity. But he was promising 8% annual returns, right? He said, "This my fund, as versus any other fund out there, is so good that it's guaranteed to give you 8% returns." Well, that should be the first uh, uh, radar that goes over your head, right? In life, when someone's promising you guaranteed returns, you might want to think, well, nothing in life is guaranteed, right? Except for death and taxes, right? As they say. So how are these returns guaranteed? So it turns out that underneath the hood, this opportunity zone fund had a lot of problems, and it wasn't making nearly the money that uh, that he was promising and had committed to his investors. So what he was doing, it turns out, according to the United States Attorney's Office, and I guess it's true because he's now in jail, is he was taking money from this investor and giving it to this investor, right? So instead of giving it into the fund and the fund generating money and then the fund distributing money to everyone, he was just taking money from over here and giving it to the next person. So that sounds a lot like a Ponzi scheme, which is exactly what the United States Attorney's Office called it. And that I won't get too much more into it, except these funds are these opportunity zone funds are there to help communities. They're there to help investors. They are a really good thing if they are the right fit for you. But there's, like in anything, there's a lot of potential fraudsters out there and scam artists. And this, wherever there's a lot of money, there's always opportunity for someone to try to take advantage of it the wrong way. So you got to really think through, because these investors, the other instances we're talking about today is where the taxpayer had the problem. They have a problem, but they're not the ones that committed the fraud. The fund itself was apparently committing the fraud, right? So you just have to understand, when you're going to implement a strategy that Nick or another advisor might be recommending to you. You have to do some due diligence to understand, is this, maybe it's the right strategy for me. Maybe my ducks are in a row, but is the whole big picture, right? Is the other stakeholder involved? Are they a credible party? Am I getting, is my spidey sense going off in any way? Am I getting the right records back from them? Did I do the minimal due diligence to see if this is a good investment? And I can't comment. Maybe these taxpayers did, and Mr. Burrell, Mr. Cheater just, kind of pulled the wool over everyone's eyes, and it ultimately blew up notwithstanding. But there are certain things that if you're going to invest a lot of money and you're looking to get a lot of tax savings, again, work with your advisors and try to have have an open mind to the fact that there's fraud out there and whether you should be, concerned about that. So just these things can go sideways in lots of different ways, whether it's your fault for not self-certifying, or the fund you're investing in is ultimately, got some breakdown. So just keep all of that in mind. But again, another good illustration where these things can go awry.
Right, 20 minutes left. So we're coming on the home stretch. We're going to talk about a New Jersey issue specifically. So remember, the SALT cap under the TCJA was reduced from unlimited to $10,000. And that hurt a lot of us, especially here in New Jersey. And so you may have heard in the One Big Beautiful Bill Act that, oh, they raised the cap. They raised it to $40,000. Well, but that's not without strings. First and foremost, understand that that is a temporary raise. In 2030, that goes away. It goes back to $10,000. So this is only here for 5 years. And if you're married filing jointly and you make more than $600,000 a year, your cap is still $10,000. So for the high income earners, this didn't really do much. And so New Jersey, what they did was we have this pass-through entity tax law, right? Also known as the BAIT tax, which allows you businesses, again, this applies to multi-member LLCs, partnerships, S corporations. This allows partners and those owners to get a New Jersey refundable tax credit on their on their taxes so long as the entity paid for the state and local income tax, right? So what we have to do, the mechanics here are that the entity has to pay the distributed share of the owner's tax. So basically, if we think about a partnership, anyone who's an S corporation or a partnership will be familiar with your K1. And so the K1 tells you what your distributed share of the partnership income is. Well, based on what you would pay in state and local income tax on that income, you can get effectively a credit on your tax return for that amount, so long as the business paid for your taxes. So you get the distributive share plus whatever you owed in taxes, you get that as a credit on your tax return. Now, there are some important compliance issues here, though, if we go to that next slide. So we need to make sure that we're doing this annually. You have to file the form annually. You can't just file it once and forget about it. Every year you have to file the PTE 100 to make sure that you're electing to do this. You have to make sure also that the business actually does do this, that the business has enough cash on hand and cash flow to pay the partner's distributive share of their state and local income tax. And don't forget that you have to still pay those estimated taxes every quarter, right? It's the state and federal income tax that you need to be paying and make those estimated payments. You also want to make sure you're checking what your income is and whether you can actually do better by just simply applying the deduction to your personal income based on what you're actually making. Because again, now there are phase outs, and so the OBBA, while it did increase the cap, it made things a little more complex because you have to be really paying attention to what your income is going to be during the year, and especially for partnerships, that can vary from quarter to quarter. So, Lance, I believe we have a case here as well.
Yeah, so in this, there's no case in this, or at least I couldn't find one. But there's a lot to talk about still. So the pass-through any taxes they're not new anymore, but they're relatively new. So let me go back and add to a little bit of what Nick said. So in 2017, when the Tax Cut and Jobs Act came out, one of the major things that it did, which created significant sort of tension politically amongst the states and whatnot, is it limited the state and local tax deduction to $10,000, as Nick said. But that was kind of a watershed event because prior to that, you had unlimited deductions. So in states with high tax states, New Jersey, New York, Massachusetts, California, we're paying a lot of state income tax. We're paying a lot of property tax. That's a big issue in New Jersey. You are able, in some states, you can deduct your sales tax. You are able to deduct that against your federal tax. Well, now they said, look, so maybe people were taking a very large deduction because they were paying a very large state tax. Well, that federal law, the Tax Cut and Jobs Act, said you can only deduct $10,000. So again, big limitation. And that was to raise revenue because now, there were other things happening. Then they were trying to raise the revenue to sort of make it revenue neutral and whatnot. Well, as Nick said, that, and one of the sort of takeaways is that while you always have to sort of keep monitoring and stay abreast and make sure you have advisors that are staying abreast of these issues, because that was a 10-year limitation. So it was going to disappear. So we just had another major tax reform at the federal level. The One Big Beautiful Bill Act does all kinds of things, and it extended and raised the deduction. So deductions are increased, but also your standard deduction that was increased. So and also the state and local tax deduction, while it was raised, it's got some phase outs. So as your income rises, you start to lose the benefit of the increase. So you've got to still think through and work with your accountant and your advisors. What's the right move? Standard deduction might be just the best move for you. If so, you don't have to worry about these pass-through taxes. Or am I going to take the itemized STOLF deduction? And if so, if I am a business owner, then I might want to look at these pass-through taxes, because when we're point again, under the Tax Cut and Jobs Act, and then again under One Big Beautiful Bill, which just came out this summer, was because the deductions were limited, right? And that's a big tax hit to wealthier individuals. what the states tried to do is to help their residents was come up with these pass-through taxes. So New Jersey came up with the BAIT tax, a business alternative income tax. Otherwise, other states just call it the PTET. So New York has it. Most states now have it. I think Connecticut was the very first that came up with it, and then most states sort of came out with one because, again, it was to try to give this deduction back to a segment of taxpayers to help them because they were otherwise paying more tax. So they were losing it at the individual level. So the state said, look, at least business owners, pass-through business owners, we can give it back to you at the business level by creating this brand new tax. So this is where the sort of some of the challenges comes in because it's not exactly a new tax, but it is otherwise a completely new tax. So when it rolled out, you had the statute, right, at the state levels, but you had very little guidance. You didn't have necessarily regulations. The states were coming out with brand new forms, so the accountants were, digesting this in real time. More states were adding it on. So you started with Connecticut, and then you suddenly had, 2 years later, you have like 37 states, I think, have them. So, and you were at the whole time you were thinking, it might go away in 26. So now one big beautiful bill comes out and says, well, this is what we're going to do. We're going to, rejigger it a little bit and do that. So it's changing all the time, which creates its first degree of complexity. And with that is, you've got to understand, like Nick said, you've got to make sure you just understand the forms. You got to make sure you understand that does it apply to you? And from a modeling standpoint, is it the right move? Right? Like I said, maybe you just stick with the standard if it applies to you, or maybe you're not going to gain that much because your income levels phasing out or whatnot. So you got to understand how it works with respect to your particular facts. And then you got to make sure you're following all the eligibility criteria because some of it's use it or lose it, right? So the election, if you don't timely claim the election, you're out for that whole year. If you're in a multi-state environment, like if you're in New Jersey and you claim the BAIT, fine, great. But let's say you're also operating in New York. Well, did you claim it in time for New York? If you didn't, you're not going to be able to claim it in New York, or you're maybe in other states. So if you're in a multi-state environment, you've got to understand each state's rules and how they might apply to you. And then there's some very complex calculations as to how these things actually work. And there's cash flow issues for the business, like Nick had highlighted. So there's just a lot of complexity. And like I said, there's no cases that I was able to find, but I'll tell you, there are audits on these because I've handled, not many, but I've had some audits in New York on these things where, an out-of-state consulting partner for a consulting firm that had a New York office, the firm claimed the New York past entity tax. This partner in an out-of-state area claimed it as well on his New York non-resident return. And it just didn't get all the forms filled out correctly, right? It's fairly complex, which line item, some code you have to put in. If you look at this, this is where people say this is too complex. And this is where I think the accountants sort of earn their keep to try and keep all these things organized for their clients. Well, in this instance that I'm talking about, the New York was denying the credit, which is sort of on the surface patently ridiculous because he's entitled to it. But working through on an appeal, I was working through all the paperwork with him. There was just some mechanics on the forms that were wrong. And New York doesn't know what they don't know. They just see the forms say X, X leads to, or A leads to B, B leads to C. Well, if the forms don't claim it the right way, then the computer is going to flag it and there's a breakdown, right? So we were able to put the toothpaste back in the tube by filing an appeal and explaining this to them. But, he had to hire an attorney. He had to go through the appeal process. So there's just a lot of footfalls that can lead to compliance that you have to go through. So it's much better to spend the time on the front end, making sure that you are doing the compliance correctly before you file, because you certainly may be challenged and have to do it on the back end to prove that you are entitled to these benefits and that they should relent, and that this is why the forms actually say what they say, because there's some missing information. Again, that's where someone like I come involved. So, all these things are good, but you've got to do them the right way. I think Nick, is that fair enough to summarize?
Listen, it's a great promotion for everything I do, right? I mean, again, it's important to make sure that we're doing the planning correctly. And it actually takes us into our last topic, independent contractors versus employees. I had a client come to me recently whose nanny or babysitter wanted to be quote unquote on the books. And I explained, well, in order to do that, you're effectively going to have to pay her about 20% more, because in order to set yourself up as a household that employs someone, you then need to get workers' comp, you need to get unemployment insurance, you need to do everything an employer would do, because this person is not an independent contractor. You can't 1099 out your nanny, because at the end of the day, independent contractors are just that. They're independent. They get dominion and control over their time. They get to choose when they work and how they work. And if this person is taking care of your children, that is not really reasonable. You can't really say, hey, I need little Johnny picked up at 3 p.m. and the babysitter said, well, I can't really work at 3 p.m. today. That's not going to work. And so, we have these famous cases too of Uber and Lyft and all of these sort of network providers who tried to claim that these folks that were all working within their network were all independent contractors, because they get to decide when they work. And from state to state, there have been some sort of inconsistencies, but ultimately the question becomes, who owns their time? And what is the documentation of who owns that time, right? And so it's very important, as we see on the next page, we have to make sure that these people are not filling key employee roles. Having an independent contractor that is your general manager, that is running your business for you, is not plausible. It's not possible, right? You want to make sure that these folks who are your vendors have more than one client, right? Because if it looks like you're the only client and you're the only person that they're working for, and it's almost full time, there's really not a lot we can do. The courts, as we're going to see, are not going to receive that very well. They have to be able to set their own schedule. And again, do not put them under your own business. Again, you want to have them have a separate business entity, a separate bank account, and make sure that, again, these folks are effectively vendors and not your employees. Because as we are going to cover in this next case in Gill, that certainly was not the case.
Yeah, thanks, Nick. So this is also, all of this stuff is fun to me, which is none of it's fun to my clients. But this is a fun area. I've written on this and talked about this a lot, because it's the states and the IRS are pretty aggressive in this area, and it's one of these things that I think is very commonly misapplied, because so many people for so many different reasons may be treated as one thing or as the other. So again, just sort of let's level set with a few minutes that we have left, and then we'll get into the Gill case. So what we're talking about is with your workforce, right? In order for a business to operate, or for an enterprise to operate, it has to have workers, right? I mean, the AI is helping us with that, as that we'll see in time, but you still have to have human laborers doing stuff. So now the question is, what kind of laborer are they? Are they your employee? Or are they an independent contractor? Are they a service provider that has their own business that's servicing clients, right? So are you their client, or are they your agent, your worker? Well, that can be its own difficult analysis, but it really comes down to whether the degree, as Nick said, the degree of control that the employer can assert over the employee, right? If there's a high degree of control, then they're an employee. If there's really just a business contractual relationship, they have, you're a customer of theirs and they've got lots of customers, then probably more of a service provider. But this can get complicated. And part of the reason it gets complicated is because there's good policy arguments on both sides. The facts can get kind of murky depending on the facts. And there's also lots of different tests depending on who is, or what arena you're analyzing this in. And what do I mean by that? It could be an income tax issue with the IRS, could be an income tax issue with the state tax authority. It could be the Department of Labor issue, right? The Department of Labor also looks at these things. So workforce development in New Jersey's been very active here. They're looking at misclassification from sort of a worker rights, where they denied like labor rights and overtime and certain like vacation benefits and healthcare benefits and things, or were they properly independent? And also from unemployment insurance, that's a whole nother area where these things can come up. So there's different tests in New Jersey. There's a pretty hot issue right now, the ABC test. So that's a three-factor test that workforce development uses to determine whether someone is independent or not from a work unemployment insurance test. Well, as we're going to see, that's one test. The IRS, from an income tax standpoint, there's these common law tests, so an 8-factor test or a 20-factor test. So again, they all sort of get down to control, but they look at it different ways and from different lenses and depending on who's looking at it. So it can, from the get-go, it can become much more complex than you think. But the last case to talk about, which I think nicely illustrates this, is the Gill case. And again, this just came out in September of 25. And this was in Pennsylvania, a refund suit where the Mr. Gill worked for Wells Fargo, and he was a financial advisor working for obviously a well-known large corporate entity. And he was treated as an employee. So he got a W-2 from them for 35 years. But he never liked that classification because he was 100% commission. His pay was 100% commission based. And the commission, so he only got paid if he made sales. So he was controlling his degree of profit. And so he went out and independently operated a kind of a business, right? He would work to develop clients, and he spent a lot of money taking clients out to lunch. The way sort of business is done. He would spend a lot of money taking people out to lunch and dinner and entertainment and all that. And that was not reimbursed by the business, but the business provided an office, it provided support, it provided him with certain benefits and things, and so he had petitioned to be treated as this. So there's worker, there's employee, there's independent contractor, there's another thing called statutory employee. Well, sort of a hybrid in between. And he had asked in the past Wells Fargo to treat him as that, because then he could claim some of these deductions on and get the tax benefit. As an employee, you don't get to take these deductions, right? But as an independent business, you get to take these deductions. So again, that's sort of the threshold issue. Well, he tried to be treated as middle one, where he would be treated as a W-2 but get to take them, and they just denied it. So and here's the problem in 1 minute. He went out on his own on his tax return, claimed his wages on his Schedule C, and then claimed his expenses on the Schedule C and netted them out. Well, that sets up kind of an optical problem because you have a mismatch. But it wasn't without, some thinking, and it wasn't without some mixed facts. But the court ultimately looked at this and said, look, applying this 8 factors, this one's against you, this one's against you, this one's against you. And yes, you have the right to kind of control how much money you make. And that's the way we analyze it, the biggest one in your favor. But there's other factors, the degree of control, the providing of the office, the ability for them to view your schedule and sort of then therefore perhaps like control your schedule. That all mitigates against this one factor, because we have to balance this test, and all of this weighs for employment and W-2, and this one thing, which is a big thing to you, but it's only one of these various factors. So you're an employee. So again, that's a kind of a high level summary, and we're out of time, but it illustrates where these things can break down and how you have to think through them and why you have to think through them and why it's worth it to go through this before you file so that you don't have a problem afterwards. Because if you do, please give me a call, but otherwise, please call Nick. Thank you so much for your time.
Absolutely. Guys, thank you so much for having us. We really appreciate it. We loved talking with you. Lance, just on that last slide, we can put up our contact information. Guys, if you need any sort of planning, give me a call if you're working through a tax issue that is requiring sort of representation. Please reach out to Lance, but we're happy to answer any questions offline. I know we ran out of time here, but thank you again, guys, for having us.
Wonderful. Thank you so much. Now that's the end of our session. Huge thanks to Nick and Lance, and thanks to everyone for being here. So see you next time. Bye.
Bye.
Thank you.